Hello everyone. In previous lecture, I talked about the balance of trade and the current account balance. We learned how economies measure exports, imports, income flows, and transfers between countries. In today's lecture, we will go one step further and examine how international trade is connected to international financial flows. Okay, let's start with financial capital. Financial capital refers to the international flows of money that facilitate trade and investment between countries. When people hear the word capital, they often think of physical equipment such as machines or factories. However, financial capital refers to money that is invested across borders. International financial capital flows occur whenever investors in one country place their money into another country. There are several ways this can happen. One example is purchasing real estate abroad. For example, an investor from Canada may purchase an apartment building in the United States. Another example is buying companies or ownership stakes in foreign businesses. A third example is making financial investments through stocks, bonds, mutual funds, or other financial assets issued in another country. These activities move money across national borders and create international financial connections. Because international trade and international financial investment occurs simultaneously, economies often study them together. In fact, the relationship between trade balances and financial capital flows is so important that economists frequently refer to the entire system as the balance of payment. All right, now let's talk about how trade and financial flows are connected. Suppose we have two groups, the home country and the rest of the world. When the home country exports goods and services, products flow outward to foreign countries. However, goods do not move alone. Foreign buyers must pay for those exports. As a result, exports generate an inflow of money back into the home country. The same logic applies to investment. Suppose domestic investors purchase foreign assets such as stocks, bonds, factories, or businesses. Money flows outward initially because domestic investors are purchasing foreign investments. Later, those investments may generate dividends, interest, rent, or profits that flow back into the home country. Therefore, whenever goods, services, or investments move in one direction, corresponding financial payments move in the opposite direction. Economists view these two flows as two sides of the same transaction. Let's look at the opposite situation. Suppose the home country imports goods and services from foreign countries. Products move into the country, but payments must move outward. Consumers and businesses pay foreign producers for the imported goods and services they purchase. Therefore, imports generate an outflow of money from the home country to the rest of the world. The same principle applies to foreign investment. Suppose foreign investors purchase assets in the home country. Initially, a move flows into the home country, because foreigners are investing there. However, these investors eventually expect returns on their investment. As they receive interest, dividend, rent, or profits, income payments flow outward from the home country back to those foreign investors. Again, we see that trade flows and financial flows are inseparable. Whenever goods, services, or investment assets cross borders, money moves in the opposite direction. Thank you for watching.